Hello everybody, another major US bank, First Republic, has collapsed in the last few days. This is the fourth bank to collapse in the last 2 months after Silicon Valley Bank, Signature Bank and Credit Suisse. Now the question here is why? After 15 years of silence, why are the banks collapsing now? Between 2008 financial crisis and 2023, none of the major banks collapsed in the world. In this video, we are going to talk about why banks are collapsing right now. Number 2, which can be the next bank on the firing lane. And finally, what are the central banking institutions around the world doing to stop this? And is that enough? Is that good or is that bad? Before we jump into the video, quick request, please go ahead, click on that like button, subscribe to the channel if you haven't already. It takes literally 2 seconds for you, but gives me a lot of motivation to continue doing these videos. So let's get started with why. If you look into the primary reasons, one of the major reasons attributed is the interest rates increase. In Feb 2022, the interest rates were 0%. And in April 2023, the interest rates are 5%. So the interest rate increase is putting undue stress on some of the weakest links in the entire economy. And those are the banks which are not diversified. Well, this interest rate hike is unprecedented to start off with. This happened only 40 years back. And what happened 40 years back? In 1978, the interest rates in the US were around 5%. And by 1981, the interest rates increased to 20%. Yes, you heard it right. In less than 2 years, the interest rates increased from 5% to 20%. To start off with, why were they low? At that point in time, 5% was considered to be a low interest rate because US was coming out of Vietnam War. There was a lot of welfare spending, state spending by the US government, and the morale was also pretty low. So there was a lot of free cash available in the market. And when the free cash regime was supposed to end, the interest rates were anyways going to go higher. And that's what happened between 1979 and 1981. And when these interest rates increased, a major crisis came up that is called as S&L Crisis, Savings and Loan Crisis. In the US at that point in time, there were associations which were responsible for taking money from the depositors and giving money to borrowers. Well, they did not do any kind of commercial activity. Like less than 20% of all their loans were given to commercial institutions. They were primarily operating within the boundaries of retail banking for regular customers like you and me. When this entire interest rate crisis unfolded, at that point in time, there were 3,400 of these S&L associations, and by the time this crisis ended by mid-1980s, more than 32% of these associations shut their shop. And the reason? In 1970s, when the interest rates were low, they have given out loans, home loans, vehicle loans on fixed interest rate. These are called as fixed rate mortgages. And when the fixed interest rate mortgages were given to these loans for 30 years, 40 years, 10 years, just like how we get our home loan for 30 years, the rate was decided for the next 20 to 30 years. And when the new deposits were coming in 1980, these guys were expecting an interest rate of 20%. Even the old depositors were taking their money out and freshly pumping it back in with the expectation that they will get higher interest rate. When there is a mismatch between the expectation from the depositor and the loan payment, the interest rate payment from the borrower, somebody who is taking the loan, that is called as asset liability mismatch. That asset liability mismatch is the fundamental root cause of the 1980s crisis within the US. And this led to, as I mentioned, 30% of the institutions shutting their shop. Now, this is the same thing that is happening once again in 2023. Because the rate of increase is very similar to the rate of increase in 1980s. And between 1980s and 2023, if we take a midpoint check-in, that is in the early 2000s, the exact same thing was happening once again. In 2000s, because of the dot-com bubble, markets crashed and governments had to intervene. The morale was also pretty low after the 9/11 terrorist attacks. So the US Fed once again lowered the interest rates. They lowered it to almost 1%. Between 2001-2004, the interest rates were hovering around from 6% to 1%. Now, when the time was once again coming to increase the interest rates, by that time, people have already taken undue advantage of these low interest rates. By 2004, when the interest rate was around 1%, 69% of the Americans were homeowners. Yes, 69% of the Americans were homeowners because it doesn't matter the price of the home. The interest rate, the EMIs were very, very low. And the banks this time did not make the mistake that they did in 1970s. It was not anymore fixed rate mortgages. The interest rate was floating and it was linked to the government interest rate. So when the interest rate increased for the government, for the banks themselves, customers had to pay higher EMIs. And when they realized that they do not have this money to even give out through EMIs, they were defaulting. They said, hey, we don't need this home anymore. Let the bank go ahead and seize the home. So the banks started to seize a lot of these high-priced homes, overpriced homes. And this is one of the primary triggers for the 2008 financial crisis, 2007 housing bubble. Now you can see how the intentions of these governments was always on the right path. In 1970s, it was to fight Vietnam War's morale. It was to increase the public welfare spending. In 2000s was also similar, to fight the 9/11 terrorist attack morale, to basically make sure the market sentiment was rising after the 2000 dot-com bubble. And now 2023 was also the same situation. Because of COVID, the interest rates hit rock bottom, 0%. And every single time they increased from 5% to 25% in 70s, 1% to 6% in 2000s, and now from 0% to 5%, we are seeing the adverse impact. And when these kind of interest rate cycles happen, as we discussed already, the weakest links in this entire ecosystem are tested. And who are the weakest links? The weakest links are the banks which are not diversified. The guys who are putting all their eggs in one basket. Silicon Valley Bank, for example, is primarily a startup bank. 94% of the deposits had more than $250,000 money in their accounts. Now, why is this a problem? Because according to the federal government rules, whatever deposits, if an account is carrying deposits less than $250,000, that is less than approximately 2 crores, then the government is ensuring and giving a guarantee to the account holder that, hey, if the bank goes down, if the bank collapses, we will pay you the money, don't worry about it. However, if the deposit holder has more than $250,000 in their account, the government does not give any such kind of promises because it's a huge amount. Now, what happens because of these insured deposits, that is less than $250,000, and uninsured deposits, that is more than $250,000? When these kind of crisis situations happen, the folks who have a lot of money in their accounts, essentially the uninsured deposits, they realize that it is not safe for them to keep their money in small banks. So they take out their money and they keep that money in big banks. And hence, the bank runs will happen on these small banks. And if you look into the average number of accounts with more than $250,000 in their account, that number is approximately 50 to 60% in the context of the US banks. So you can see that's a high net worth individuals bank. If you look at the average amount for the US, it is around 50 to 60%. Only 50 to 60% of the overall deposits have more than $250,000 in their accounts. But for SVB, that number was close to 94%. And for Signature Bank, that number was close to 88%, way above the average. And for First Republic, that number is still higher compared to the average, 66%. So if you have to basically understand which bank can potentially be next on that line, the banks which have taken undue risk, that is not diversifying themselves and probably taking a lot of money from these HNIs. In good times, this is a good thing because banks need to make money and they can take as much money as they want. And that's how they also make money, by giving out loans. So in good times, all of these things work. But in bad times, well, you can see the impact of non-diversification. And as we jump into what is the federal government, the regulatory bodies around the world, what are they doing right now? You can see the Fed report coming about the post-mortem result of the Silicon Valley Bank failure. And this post-mortem analysis indicates there was mismanagement by the leadership within the bank, and number two, there was lack of regulatory oversight. And they are going to hire probably 10 folks in the regulatory departments, and they'll increase the scrutiny on these banks. But would that help? Is that the right step? In a capitalist economy, everybody is motivated to make more money, take risk, make higher profits. That's the rule through which capitalist economies work. And if we introduce more oversight and start putting barriers, then the economy itself will fall apart. So regulatory oversight, increase of regulatory oversight might not be the right answer. Well, this is a fascinating topic and discussion for itself over the long time. But to state what Milton Friedman has mentioned, governments never learn their lessons, only people do. Hope you agree with me, and if you have any counter arguments, please do let me know in the comments, and I will try to share my opinions on them as well. Thank you so much, guys. Look forward to interacting with you, and please go ahead, click on this like button if you have derived any kind of value from this video. Take care. See you again. Bye-bye.